Selling iron condors feels safe, especially when markets are quiet. Use sell premium. Collect $100 to $200 at expiration and repeat the process. It feels stable. It feels predictable. And for a long stretch, it can even look like steady income. But there is a truth behind iron condors that most traders never discover until it is too late. One single bad day can wipe out an entire year of gains. We check this using real market data. Not hypothetical results, not assumed pricing, not back-of-napkin math. We ran a real-world study of 625 SPX iron condor trades using actual quotes and actual settlement prices. Starting from mid-2023, when VIX20 became available, this gives us around 2.5 years of real intraday conditions, real volatility environments, and real risk. On paper, the performance looks great. Starting with $10,000, the strategy finished at $19,811. That's a total profit of $9,811. The win rate was 81%. The average profit per condor was $15.70. The best trade earned more than $1,400. But then comes the pot traders ignore the worst trade, lost $4,722. And the max drawdown wasn't mild. It was negative 156%. That means the strategy effectively blew through more than the starting account value at peak loss. Now, think about this. Most winning condors make about $15 to $30 after commissions. Many traders place condors multiple times per week, believing they are building consistent income. And in the short term, they are. But one large loss equals nearly 300 profitable trades. One loss equals almost 1 year of work. That's the real danger. Not that iron condors lose often, but that when they lose catastrophically. And losses don't arrive randomly. They cluster. They show up around CPI releases, FOMC events, macro shocks, unexpected announcements, Fridays with heavy gamma exposure, or low volume sessions that suddenly break direction. The strategy behaves like nothing is wrong, right up until everything breaks in a single move. That's why so many people believe iron condors work well until the day they don't. A trader who started during quiet volatility regimes sees consistent winners. They think this is passive income. They increase contract size. They stop hedging. They stop filtering events. And the moment volatility spikes, all past gains disappear. This isn't emotional fear. This is the math of asymmetry. The profit side is cap small and slow. The loss side is open fast and violent. And no matter how good your win rate is, the tail event dominates the long-term outcome. The backtest revealed something important. The strategy didn't collapse gradually. It collapsed instantly. One loss. One surprise move. One day where price stayed outside expected move. And it erased months of profits in minutes. This is why traders who have made money selling condors so far may simply have been lucky. Not wrong, not irresponsible, but lucky that risk hadn't yet shown up. But here's the good news. Iron condors are not doomed. The edge is not in selling premium blindly. The edge is in avoiding catastrophic losses. You don't win by squeezing more dollars from theta. You win by eliminating the days that carry disproportionate risk. When we filtered out key risk days with major economic releases, days after large overnight moves, days where VIX20 implied ranges were already inflated, the drawdown profile shifted dramatically. The strategy didn't need more wins. It needed fewer disasters. And iron condors do have a structural advantage. They earn when markets behave normally. They earn when volatility contracts. They earn when price mean reverts intraday. But the success of the strategy is determined not by the wins, but by preventing the blowups. So the real lesson is simple. If you've been profitable selling condors, don't assume you've discovered stable passive income. Understand that one bad day is equivalent to hundreds of good ones. If you don't prevent the catastrophic move, nothing else matters. In upcoming sessions, we'll go deeper into improving survival, How to identify danger days before they happen, how to hedge cheaply so that one event doesn't destroy your portfolio, how volatility filters and intraday delta adjustments dramatically change the expectation curve, and most importantly, how to convert iron condors from a fragile strategy into a robust one that docent teeth implode when volatility returns. Because iron condors don't fail slowly, they fail instantly. And the difference between being lucky and being skilled is whether you survive that moment when volatility finally shows up. Subscribe for more ODTE trade ideas.